Hello and welcome back to our essentially follow-up session from our last video that we posted on the major workforce updates that are upheaving right now the federal employee workforce. So today we're going to talk more about the economic impacts of what's going on, specifically tariffs. Tariffs have been a major concern for folks that are watching inflation, right? Inflation has been a major concern for the stock market and the economy. So today we're going to talk about that aspect and hopefully put some research to work that we've done to keep some of your fears at ease in this kind of volatile situation that we've been looking at. So first thing is just quick introduction on myself. I'm a certified financial planner here at Capital Financial Planners. I have been working with federal employees for all of my career, and today is going to be the same case. We're going to talk TSP as well as some other investments. So tariffs. Why tariffs? Well, it's no doubt that the U.S. as a economy and country is in fairly significant debt, right? And the tariffs are a part of the Trump's administration strategy to reduce the federal deficit and the spending that we've been doing as a country. So the question is, has this been successful in the past? Well, it's hard to say, but what we can say is we have seen a significant deficit occur since the early 2000s, right? You had Trump's administration right there in 2018. Some tariffs were put on at that point, not at the ones that are proposed, but we didn't see really a major impact to the deficit in the first wave of tariffs. Now, the second wave of tariffs, if we look at this, right, is fairly substantial. We haven't seen anything in terms of this proposal for tariffs since the Great Depression. Okay, not the Great Recession in 08, the Great Depression. Now that may sound some alarm bells for you guys. This is not to scare you, but these are the order in terms of magnitude of what the current administration is discussing. Now, we do believe that some of these are just for kind of negotiation or scare tactics, especially the ones that are being proposed to Mexico and Canada. We already saw those drop off within a short time frame of being released, and really they're being negotiated for border security, drug trafficking, those types of things. We don't think that the ones being proposed will actually be the tariffs that are in place for the next 4 years. So just put it that way. We're not expecting a massive tariff like on the screen. However, Trump's administration does expect to keep tariffs in place for China, right? And those are currently in place. Those were not taken off. Mexico and Canada's, as of the date of this recording, have been postponed. And I believe that there will be a resolution to that will keep the markets somewhat happy. So to look back at Trump's team's last, call it trade war, tariffs were placed. But if we look at the effect on inflation, which is what the market's most concerned about right now, because inflation to the market is like, throwing kerosene on a fire. We do not need higher inflation after already tackling higher inflation in 22 and 23. But if we look back in the segment that the Trump administration put on tariffs from 2018 to the end of 2020, we can see that there was not a significant impact in those years to inflation, right? What ended up causing inflation in 22 was really not even a byproduct for the most part of those tariffs. It was the reaction of COVID in terms of interest rate drops, money printing that we saw, so on and so forth. So this in itself looks like a better scenario when you start to go down history of how the last time we've enacted tariffs have been in terms of an inflation increase or not. Now, we went even further back. We looked at tariffs versus inflation all the way back to the 1900s, right? And as you can see, back in 1925, tariffs were exceptionally high, right? They were about 20% of all taxes coming in through the federal government. Tariffs made up a large or 20% part of that. We ended up having deflation during the 1920s, followed by an inflationary period in the 1940s. Okay, all the while the tariffs were actually being decreased during that time frame. We saw flare-ups of inflation in the 70s, not really directly tied to tariffs, but more so oil shocks that we saw in the 1970s. And then we saw obviously a rise in tariffs right in the looks like I'll start my pointer here, but right here, right? We had 2020 spike in tariffs, that was COVID, 1970 COVID shock, and then we had high inflation in the 40s. What were these due to? Well, really, these were due to World War II ending, right around the 40s. We had oil issue in the 70s, right? I can remember stories my dad told me of cars lined around the gas station, right, in Kensington, Maryland. And then we had COVID, right? These were not directly tied to tariffs. So again, we're not seeing a theme play out that tariffs directly and quickly cause inflation. So I think we could put some of these fears on the back burner for now and at least keep an open eye to what inflation's doing, but not necessarily believe that tariffs directly are going to impact that. Because the fear would be that if inflation were to rear its ugly head again, right, we could see a significant decrease to the stock market, right? When inflation went through the roof in COVID, the stock market dropped by 25%. We actually saw an increase to inflation right here. The stock market dropped by 50% in 2008. We know that. 2001, we saw another recession take place. We saw a flare up of inflation again. Additionally, in those 60s and 70s periods, take a look at the market, take a look at inflation rearing up as well. So really, we've only seen one period of time over the last 60 plus years where inflation made a rise up and actually hit about 5%, and the markets continue to chug forward. So it has happened in history where the market an economy just digested the inflation and continued to steam upward. But in all other instances, 6 instances in the past 60 years when inflation rose, markets collapsed. And I wouldn't say there was a market collapse in 22, but a 25% is a fairly decent correction on the market. And you could see something along the lines of that because right now the market is about 30% in terms of a PE ratio overvalued on its historical 6.5 PE ratio rate. So anything could spook the market, especially inflation. But again, we don't think that the tariff scenario will have this huge impact on inflation. Inflation could come from any other scenario, right? And tariffs could exacerbate it, but on its own, we don't see that as being the only catalyst that would drive inflation up again, okay? Now, What are we recommending to our clients with the risk that inflation could go up, right? Inflation could go up for a few reasons. If they were all pulled together, it could happen, right? If you got tariffs, you also have a lowering of interest rates at the same time that would spawn growth or more stimulus out of Congress, right? This could all drive inflation up. So how are we maintaining a balance in our portfolios? Right now, we are actually favoring value over growth. In the S&P 500 right now, which is your C fund at the TSP, there is a major onus towards growth. In fact, 10 of those positions make up 40% of the C fund, which are all growth names. Okay, NVIDIA, Tesla, all those names. We are suggesting that clients diversify away from what is now a growth proxy in the C fund and utilize some of those names that are less popular right now, but are much more lower in volatility and much less pumped up in value. Also, we are recommending the use of intermediate bonds as a portfolio buffer. We're not recommending that folks use longer term dated bonds right now just for the risk of inflation raising back up, and that could send negative returns in the longer term bonds. But we are recommending the use of intermediate term bonds like treasuries and so on and so forth that we are currently using in our portfolio. So this is our strategy, and we believe that that strategy will pay off. If you look at value investing, which we are key on right now, and you look at periods of time where the 10-year treasury, which by the way currently stands at 4.5%, the 10-year treasury is at 4.5% right now, right? If you look at periods of time where the 10-year treasury was between 4 and 5%, value absolutely outpaced growth stock positions. Okay. So by value, we mean lower PE ratio companies that are trading at more, call it bargain level places or prices rather than those growth names. If we look at a north of 5% on the treasury, we had value also beating growth. And this is data from 1979 until present day. Okay. Now, for sure, when we see low interest rates, growth highly outpaces value. And that's what we've seen over the last few years, right? If you take a look at growth over value, there's no question, but we are entering into a new regime. We've been saying this for months to our clients. We started repositioning our portfolios over about 6 months ago. So we may have been a little bit early to this trade, but we think that this will put a nice ballast on folks' portfolio if there are big retracements of prices on growth positions, right? So this is how we're allocating our investments. We would recommend that you take the same strategy across your own personal investments, and you can look inside your different fund selections as well to see what has a little bit lower of a P ratio and what is a little bit more less of a volatile potential position in the stock market moving forward. So I hope that resonates, at least the logic of what we're looking at and why we're making those calls right now. Again, I'll end this on the same slide as I do oftentimes. We're recommending that folks stay in their normal allocations. Adjust the allocation to fit the times is all. You don't have to dump all your stocks and go into the G fund or something like that. Just be in indexes that don't have these heavy weightings towards growth right now. That generally, historically, has not been paid off in these high rate environments. especially with the risk that inflation could continue to be high, where rates have to stay higher for longer. So that is our recommendation. By all means, if you're a client and you have questions, please reach out to us. If you have a new case where someone is not a current client of us and you'd like to come in and see us, please go ahead and scan the QR code. We would hold a one-on-one meeting with you to discuss some of these issues, and you can sign up directly on our website by going to retfed.com/register. Lastly, if you're new to our YouTube family, please like this video. It sends the algorithm out to more federal employees. Subscribe to our channel. I know you're watching this on YouTube, but what you can actually do is send this to some friends. Send this to some colleagues that might need a little bit support right now. Ask them to subscribe and like our video as well. That always helps. So again, thank you guys so much for sticking with the entire presentation that we had. It took us some time to put all that together, and hopefully that gives you a little bit of ammunition to stay pat in some of the things you're currently doing. Or if not, and you're using a lot on the growth side, you're using a lot of C-Fund, to maybe make some adjustments in your own TSPs. Thank you so much. Take care.